We're going to be here talking about what are the undercapitalized opportunities that are left here in crypto. So I want to just give, I think most people probably know you guys, but just to give a quick framing of what we've got here on stage. So Raoul, you're a macro mega bull.
Yeah.
You've called for Bitcoin to go to $1 million.
I don't know when, but yes,
okay,
maybe.
You're bullish.
I'm very bullish.
You're very bullish. Okay, Diogo, your background, you built Anchorage, one of the largest custodians in crypto, very institutional business, and now you're a VC covering tech, fintech in the crypto space. So the first question I want to ask you guys is, what are the indicators that you guys look for from a macro perspective that you think are most, that if someone's just going to look at one or two indicators that are going to tell them most of the story, what should they be looking at?
For me, it's pretty straightforward. When I look at what moves Bitcoin, 90% of the entire price action is explained by liquidity. So yeah, we build complicated models for that. How do people look at it? Pretty simply, look at what the dollar's doing, and the other one is look at global M2, which I think you can get on TradingView. Those two will give you a pretty decent idea of the forward direction of the market. It leads by about, global M2 leads by about 3 months. So that's an easy way. Our financial conditions, easing or tightening, is liquidity coming into the system.
So what's M2 saying right now?
M2 says, and it's been mapping like a 98% correlation recently, which is very high, and it won't last, but it just basically says up only all the way through to the end of the year.
And is this only for Bitcoin, or is this
alts
as well?
So what happens is, particularly at this phase in the cycle, which is the debt refi cycle, what usually happens in year 4 of a crypto cycle is that alts start to pick up as well. So risk-taking goes out the curve and goes further out. So Bitcoin dominance tends to be high, with a few projects that have been chosen. So Solana and Sui have probably been the two of the last 2 years. But what happens in the latter part of the cycle is usually alt season. And it won't be everything because there's millions of alts now. I mean, who knows, right? But generally speaking, a lot of things just number go up. So it becomes a much easier risk-taking environment, and you confuse yourself with being a genius because everything you touch goes up.
I hate that I'm dressed as the macro investor and you're dressed as the startup guy. There's a mistake here.
I don't know what's going on here.
I will not do macro, prediction. Well, one thing to say is that obviously across time there have been a ton of different narratives. And if you were talking about something like Bitcoin, there's not a uniform narrative. There's a bunch of narratives that are overlaid on it. There's the risk asset narrative. There's the obviously store of value narrative. There's the mimetic narrative. There's the opt-out narrative. There's the payments narrative, no matter how small it is. And so there's all these narratives that are overlaid. It just makes it so hard to understand because it's like extremely complex system, and the overlay of all these things kind of moves alongside it. Ultimately, in general, I agree that liquidity runs a lot of the things around us. Let me just switch the focus a little bit. Obviously, crypto is many things. One of the things that it is companies and stable coins and companies that have real revenue. And so one of the things that I like to look at is what is the global set of the sum of all of the either run rate or recurring revenues that the companies that are actually operating crypto have. Obviously, you have accessory companies and infrastructure companies, legitimate recurring revenue. You can sum all of that. You have run rate and GMV and GPV and all these other metrics that you can collectively look. And I like looking at it from the lens of companies versus the lens of the blockchain. Because as you know, historically, we've had things like TVL, which are easy to fake and fool. And it's very hard in a company that has metrics that has quarterly.
So if you're just looking at companies, obviously the biggest companies making the most money in the space are exchanges, and their revenue is very pro-cyclical. What does that tell you? Where are we right now in the company revenue story?
They're the issuers making the money. The exchanges.
That's true. Tether's also making a lot of money.
That's number one. No, and you look at it and you realize that they actually have many different businesses. If you look at the Coinbase K1, you realize that a big portion of their revenue, which is great for them, diversified on dollars, is obviously coming from Circle and USDC. You realize they have a Coinbase Cloud, which is a growing business, a combination of recurring run rates in platform fees and staking fees. You realize they also have like the fees themselves for the trading components. They have the institutional side. So we look at this actually pretty carefully. They're very well diversified revenue businesses, and that is a good way to actually go at the system and inspect and say, okay, this is recognizable, publicly traded numbers that are actually being reported with legitimate accounting versus going to a blockchain explorer and saying, okay, this is what's actually.
Okay, so Robinhood Q1 numbers I think just came in, and they were below what they were in Q4. So it looks like trading volume has pulled back somewhat in Q1. What does that tell you?
It's all about liquidity.
It's all about liquidity. It's all about liquidity.
It's all about liquidity.
Okay.
So when liquidity is drying up in the system, there's less volume.
Right.
When liquidity is plentiful, people have more money. Now, one of the things we've got right now is the business cycle is still pretty negative. So the ISM below 50. what does that mean? It means companies aren't earning as much, and households aren't earning as much. So therefore, people aren't taking as much risk. As liquidity comes in, people start recycling capital into financial markets, volumes go up. So we saw that at the back end of 2024, Q1 was the payback for the strong dollar and high rates that happen with the 12-week lag. So it's all liquidity.
Right. Well, but
corporate earnings are liquidity and business cycle too.
If we're looking at the crypto public markets, sure, but at the same time...
Early stage is different.
Right. Issuance is at all-time highs. RWAs keep being issued on-chain. GMV of stablecoin companies are blowing up. Revenue is increasing. These companies are 3xing year over year. They have great retention rates. And so crypto is not a monolith. There's all these companies. If you want alpha, obviously as venture investors, very long-term horizons, we're investing in these early-stage companies, but it's not just about the tokens. Yes, we have token warrants. We have these liquidity-dependent components at the end of the rainbow in terms of liquidity, but there's a ton of crypto that has nothing to do with publicly traded tokens, and that is growing. And in fact, it's fantastic because if you look at crypto as overall, before we had Bitcoin, and then we have all these other things, and now we actually have a pretty good set of a portfolio of different things that operate in tandem.
And are you finding more opportunity in the equity or the token side of early stage?
It actually, even that, it's a wave. Yes, there's been the L1 narrative, and there's been kind of like the primarily tokens where all the VCs were looking at it. And for example, we were into Bridge, and we were part of the acquisition into Stripe. And if you see that was an investment almost 3 years ago. So 3 years ago, you had to be looking at equity only. None of these companies ever going to issue a token. Anchorage certainly is not really going to issue a token. We're a federally chartered bank. And so it's like that actually takes away from the reputation and trust. And there's so many businesses that are growing so fast that are so necessary to bridge this TradFi world with the DeFi world that have real alpha and that are generating revenue. And we should talk about the M&As, right? This year alone, we had like 3 multi-billion-dollar or over $1 billion acquisitions. So what a great way to show that the market is maturing.
So that's certainly a good sign for the industry. At the same time, if you look at the crowd of people here, they don't get to participate in private market investing, right, for the most part. So their access is through public companies or through tokens. Now, your story, Raoul, is that most of this is being driven by global liquidity. Is there ever going to be a point where crypto asset prices decouple?
No. I mean, just to go back at the points you're both talking about, there's another factor here that's really interesting to me, because one of the things I also run is a fund of crypto hedge funds. What we're finding is VCs get in early. The price of the token generation event is generally too high for the market demand because of liquidity. So what happens is the tokens drop early, and then what it leaves is the hedge funds, who are really the primary sources of capital in the secondary markets, and they're not that big, to find tokens now at a discount. So these things all fall about 70%, and it gives them a secondary opportunity. That is the same opportunity retail gets as well. So it's not to buy the token generation event, it's let it settle for a month or two, and then look at classic, network adoption model. What's getting adoption? I use kind of Metcalfe's law approximations to do that, and you can find from that great opportunities. So you can get a double stab at the same thing, which is why we're seeing these hybrid funds as well that will also, do the early stage, get the token, do the token generation event, and also will buy tokens. So there is opportunities for retail within this.
Okay.
And we're also seeing, by the way, I think in general with venture, major pullback on any kind of fundraising round pre-TGE. Just people are realizing that it's actually the worst risk reward.
Yeah.
You're demanding the highest valuation before the token gets listed, and you have made basically no progress. I already can inspect like your testnet or whatever, the difference between a testnet running and the mainnet running, there's no difference, and you're trying to get a massive uptick on the valuation. So here is interesting. And I hear you on retail does not have access to the private markets. It's been one of the major conversations over the past few decades where if companies are staying private for longer, even outside of crypto, then retail doesn't have access to. Hopefully we would have an ability to do it. And I think one of the narratives that is actually pretty exciting right now and that actually may change this is crypto taking its own hands, IPOing crypto companies, so on-chain IPOs. I think that would actually be one of the ways in which we can solve this liquidity crisis.
So are we going to see a rise of the ICO market in a different format? The capital formation, it feels like it has to happen.
That is a fantastic debate and a fantastic conversation. I think the one way in which we have to come at it, we came at it on the ICOs with just, this is a fundraising mechanism in which essentially people have no rights. And now what we're doing is, no. Regulated institutions that can issue securities on chain that already have rails and platforms and are under the SEC and have told the SEC and are collaborating with them are creating tokens that are a superposition of a publicly traded equity and an on-chain token that have the same rights, same set of rights. So now you have rights to the obvious cash flow, you have governance rights, and these things actually are in a superposition. That is actually what's exciting to me, is sort of The availability to the markets that the ICO markets were available, yes. So the liquidity that comes from more retail earlier on the, so not institutional, necessarily institutional, but the same type of rigor and transparency that we have, or at least very close to it, to the public markets. I think this is actually the new innovation that we can help ourselves to solve the problem that you're saying. So people can, without being major institutional investors, get access to tokens and crypto companies and equity even on an early stage on-chain without having to suffer through this, candidly, what we saw with the ICOs, which was there was no control, there was no standards, there was no really standards for transparency. Sure. It was all.
Okay, let's talk about the private markets then. So the title of this talk is about undercapitalized alpha. Historically, in 2021, 2022, you saw an enormous supply of capital being provided to the market. Huge private fundraisers, huge VC funds getting raised. And what you've seen over the last couple of years is a major pullback in the amount of capital coming into the space. Now, some people would say that that's good. Some people would say that that's bad. How do you guys read the change in the capital supply in crypto and what effect it's had on the overall market?
So for me, there's still a skew, which is VC versus professional capital in secondary markets, right? The hedge fund industry is about $12 billion in crypto. It's $4 trillion in traditional markets. Right. While VC, let's say, take a peak of 2021, raised $64 billion. So we've got, what happens is these token generation events happen, there's just not enough professional capital, which means that for me, the hedge funds have huge alpha because they're not competing with, currently in the US, there's more hedge fund managers than there are managers of Taco Bells. Right, there are so many, right? Okay. So that's how competitive that market is.
Well, why do you think there's such a big delta?
Because they haven't been able to raise capital yet.
But why? Why aren't they able to raise capital if the alpha's there?
Because it's easier for investment committees of family offices and institutions to put it in the VC bucket, because then they don't have to say it's crypto. They can just say, oh, it's technology. Right. And then they don't need mark to market because they don't know how to deal with the volatility. Right. So these hedge funds are volatile. If they're directional, they're very volatile. But the returns have been stupidly large. But the investors don't know how to deal with them yet. But it's coming. So
VCs were relatively attractive because they're hiding the volatility in these illiquid marks.
Very much so.
What's your take, Diogo?
Well, I think crypto really proves out the inefficient market hypothesis.
Nice.
Look, there's a lot of alpha, especially when you're actually looking at how inefficient these protocols are. Protocols coming out all the time. Tons of interesting new economic mechanisms. There's so many ways to actually like on-chain to make money, on arbitrages, and on just participating in these protocols. Think about this. What we've created as an industry with tokens is this magical power to overcome the cold start problem. We can overcome the cold start problem by aligning incentives our early users with the actual network participants and create a network that has network effects in which value accrues to token. That is a superpower. But it has a super weakness. The super weakness is the fact that tokens hide away product market fit. Nobody really knows if these things are working or not. And I think related to this is the fact that there's a lot of alpha and a lot of, if you understand what's actually happening and how the economic incentives are actually structured, you can actually make great business decisions on how to make money here. But this is the active side of the market, right? We spend a lot more time, and I spend a lot more time thinking about the active side of the market of how I can, like, I don't know, triple lever, use some flash loan to actually take advantage of some arbitrage. That's really not what I do. There's always going to be alpha in amazing founders building amazing products in some new rails and some new opportunities that just come up. That will never change. It hasn't changed to this point. We have been doing this for a century of the venture capital markets, or just under that. And every new wave of technology creates a new set of founders that see the opportunity and actually are able to capitalize it to build real businesses. So that will always have alpha at the earlier stages of like really like seeing the present clearly, seeing through the lack of product market fit, through the tokens, to the incentives, into real businesses.
Sure. So one of the things that we've seen over the last few months is the relative outperformance of Bitcoin, underperformance of alts. And it's been something of a bleed that's been happening over the last roughly year and a half, call it. And one of the common refrains you hear from people of why this is happening is an oversupply of tokens. Is that basically there's too many tokens launching. Yeah, the valuations are high, but also there's just too many of them. And does this resonate with you guys? Do you think this is correct? Or is this a misdiagnosis of the problem?
I think there are more opportunities than there is attention. We're still in an attention-driven market. So, you know, we saw it with meme coins. They got oversaturated, then attention gets spread, and therefore number doesn't go up anymore. But overall, if we think about alts, again, it's where are people in the risk-taking cycle? It has been driven by the ETF flows. We've not had household earnings going up. We've not had capital to reinvest.
It's liquidity. It's always liquidity.
It's liquidity. And so what will happen is, yes, a bunch of these alts will not go up and they'll go to zero. We all know that, right? They're all still early stage businesses and the tokens are very early. But there'll be a whole chunk of this stuff that will outperform, and we'll be scratching our heads on why Doge has outperformed Bitcoin in the last 10 years,
So, okay,
stuff like that.
Why does this liquidity story predict the disconnect between Bitcoin and alts?
Because it's every time, it's the business cycle. So I've got a nice chart that shows every time the business cycle picks up, what happens is alts outperform Bitcoin. It happens every cycle. It's exactly the same as small caps outperforming large caps, emerging markets outperforming developed markets, the same for high yield outperform. It's the same risk curve, right? We think that crypto is some unique beast. It's the same macro thing. It just happens to be a more volatile and faster growing opportunity.
Okay. Well, Diogo is a VC. You and I, are we part of the problem? Are we creating funding too many of these tokens?
Yeah, for sure.
Do we need tokens for everything?
The answer is no, but again, like, it hides product market fit. It looks like everything is going initially very well. You can mark up your bag. So the incentives for VCs are also not aligned because you can yourself get caught up in the fact that these things are working when in fact they're not. And then only when the tide goes out, you actually see who's swimming naked, right? So I will say on Bitcoin, look, we can't have all these tokens have this characteristic of reflexivity and moneyness. Moneyness is one of the things that has clear network effects. And so there's not that much space for as many of these. It turns out that these other tokens can't benefit from that characteristic and have to benefit from the closer to business metrics characteristics and some other types of utility. And so when you see that, obviously there's not as much space for all of these. The way that I see, for what it's worth, and we still see layer ones being like funded and whatever, the way that I see this comparison is actually an interesting one, which is probably the best analogy is programming languages in terms of how many blockchains will it have. What's the answer to how many blockchains will we have? And so how many tokens will we have that are layer one tokens? And we can talk about like the ones on top of that. But if you think about it, programming languages literally all do the same. They are all Turing complete. Definitionally, if a program can be programmed in one language, it can be programmed in another Turing complete language. So they're all the same. So why the heck do we have thousands of them? And right now, hundreds of them that are actually used on a natural basis. And why do they change the top 10 over time? Well, it turns out that programming languages, there's two reasons why they actually get to popularity. Number one, they create some new intrinsic innovation. So you go from something horrible like assembly into something that is actually much easier to digest like C. And then from C, you have memory safety. You have thread safety. You have English-like programming ability with Python and reasoning. And then that's one of them, so technological changes. And I think we can actually make the equivalence of like, Bitcoin being assembly, Ethereum being C, Solana being Rust, whatever it is that you want to talk about, you can kind of like see these. And then the next thing that happens is the only next programming language that gets popular is because of some external technology wave. What are those external technology waves? The rise of software. The rise of the web programming give rise to Ruby on Rails, and the rise of AI gives rise to Python and AI-specific programming languages. Mobile programming gives rise to Objective-C and Swift. That is the only case in which now the next top 10 programming language actually gets to exist. And sort of because there's tokens, we VCs forget that to get to the top 10 programming language and to have actually a massive outcome, you actually need an external wave of technology because we already have all the competition on the ground. We already have all of the basic programming languages.
And I used to look at all of this stuff to assess, what is going to last is all of this uses network adoption models. So there's a lot of people using discounted cash flows and all of that. It doesn't work. The reality is it's network adoption. So how do you approximate Metcalfe's law? Metcalfe's law is what Google is, what the programming languages are. They're all network adoption.
Can you explain what Metcalfe's law is?
So Metcalfe's law is essentially the square roots of the number of users, or the square of the number of users. But that's complicated. What it really means is number of active users and total value transacted on chain, or number of builders. You can approximate that side. I found the easiest way to approximate it is total value transacted, let's say, in a week or a month, total number of active users over the same period. You chart that, and it exactly mirrors almost every crypto. So the market is pricing it according to network adoption. So then what you're looking for is number of users going up. Okay, and that's number one thing, if not, or you have a few number of users but massive value. Now, Bitcoin has both. High number of users, massive value transacted. Ethereum, lots of value transacted in smaller transactions, but huge numbers of users. Solana, they all fit into this model. So it's an easier way to decide what's got real network effects, what's a real project, and what isn't, and not using stuff like TVL and all of this stuff because so much
but there's
can
a
be
bit of a
gained.
disconnect here between the story the two of you are telling, which is that increasingly what you're seeing in criticism of a lot of these tokens is that, okay, once upon a time they traded on a narrative of like, oh, I'm an L1 for AI, I'm an L1 for this, L1 for that. And now increasingly those stories are being jettisoned in favor of show me the revenue, show me the fees, show me the TVL.
He's got the harder job because he needs to decide, can this have network
Job's
adoption?
not that hard. You're giving him too much credit.
But you've got to decide, could this have network adoption?
Yeah.
I'm more secondary market active,
Right.
and the hedge funds that I invest in are all secondary market active. Their job is to say, well, I just prove that it's got network adoption. It's much easier than I think the VC.
But you can fake network adoption, right? So we say users, really we mean addresses.
Yes, but addresses need to have activity. So it's the two things. You can fake it for a period of time, but if not, the foundations run out of money. So, there is a period of time that...
Diogo, how is the way that you've underwritten these chains changed over the last, call it 3-4 years? Is it basically the same, or has your approach changed?
No, it's definitely changed. I mean, there was a time and period in the ecosystem where TVL was the only thing that mattered, and we saw so many games being played together. And earlier from that, there was a time in which people actually cared about addresses generated. I mean, think about that. Literally hashes of public keys. The number of hashes of public keys that are out there transacting. Obviously, that's not a good metric for anyone. Even it's at best like a paintbrush style of approximation. We just didn't have better ways. This has actually evolved, and in fact, it kind of ends at the end state, which is kind of fascinating. This is a recommendation that we tell entrepreneurs all the time, which is sometimes at the earlier stages, it's actually much better to go fundraise on a story than a real revenue. So do not show me the 100K or the 200K of revenue you have, because you're going to be judged on whatever growth of this low base, which is meaningless, but you can't get out of the fact that it's only 200K and you invested at a $200 million valuation in a company generating 200K, but it's much easier to invest in a $200 million valuation company that has zero revenue, but it's going to be 200 million, right? And so it's kind of funny. And the reason why I'm saying this is because you get all the way to the other extreme, which is deepen, are projects that have some kind of like physical representation in some real revenue model or a lot cleaner revenue model. And so they're the worst affected by the lack of narrative because there's something real that I can point to. So to a certain extent in crypto, you've seen this. And it's part of the reason why, again, I think there's a divergence between Bitcoin and everything else, because Bitcoin has moneyness, has all this like intangible way of pricing it. And even though I agree that generally over time, like developers and all these other metrics have been decent proxy metrics, like I think everybody else that wants return over the long term, especially venture style returns, 10x, really is trying to ride on something else that is more real to the business. Especially as around us now, we have stablecoins being issued on these chains, we have RWAs, that's real take rate, those are real business, real institutions. And so to a certain extent, it's like, how much of that value should be accruing to the blockchain? It's basically crystallizing. There's real revenue metrics now crystallizing. That's actually worse for valuations, which is funny, because it should be the opposite way.
Okay, so coming back to undercapitalized alpha, you mentioned deepen. What are some of the sectors that today you guys feel are undercapitalized and need more investment? Is it deepen? Is it RWA? Is it fintech? Like, where do you feel like the money should be going but isn't going today?
I think it was with CZ yesterday. He said this thing that everybody says, Toli says it, everybody says it, is like people are not building enough applications. So we can build infrastructure stuff, we can build, the financial stuff will happen anyway. There's so much incentivization to get involved.
But when you say applications, does that mean social? Does that mean games?
Where do the billion people come from? Where are the 2 billion people? Well, finance is one of them, okay, we know that. But then there's the big cultural communities of gaming, entertainment, sports, social media, all of these things. We've failed to get any of those any traction. But as soon as one of those happens, it's going to change this entire industry of crypto, because suddenly we go from 500 million active users, or 600 million where we are today, we will go to 2 billion, 3 billion. Digital ID, one thing could easily get 3 billion users. Okay, that's a game changer. They're not high economic activity. In Metcalfe's law, it's a lot of those, but very small value.
Right.
But once you've got that, if you think of what happened in India with Aadhaar and the India stack, is once you build out the UPI payment system, they built all of the fintech rails on top.
Right.
So once you've got users who are active, you can build anything on top of it.
Diogo, do you agree with this story?
No, I'll take the other side of this one. And let me just say the following, which is, I don't know what's undercapitalized, but there's things that are clearly overcapitalized. It's much easier to tell what's overcapitalized, layer ones, et cetera. There's not enough either technical innovation or some new external wave of technology that requires one of these. We basically have built, like, through the cap theorem, all combinations possible of this thing, which is fantastic. It's what it's supposed to be. And what the market is telling us is that, again, like, we've already done enough experimentation, and there's already a bunch of winners, and we sort of already have our winners in the category, so I'm not going to take the market's not going to compensate me from the risk for the N plus innovation unless it's actually really, really major. Now it needs to be major innovation. So that's the market telling us that has been overcapitalized. The reason why I'm taking the other side of this is because build it and it will come in general is a bad investment strategy, but it's kind of funny how stablecoins have been that, right? We built stablecoins because we wanted to trade over the weekends and we wanted to have a dollar that moved at the speed of crypto rails. So we built it for trading, for speculation, and all of a sudden we can see it with our own eyes, not just businesses, but just retail accessing dollar and like these applications just adding ledgers and dollar ledgers permissionlessly in all these countries. And I've seen the pitches. I'm being pitched tons and tons of like consumer fintechs that would never pitch me because they didn't have a crypto angle, except that now they do because they're building all of their infrastructure in crypto. So I actually don't see people, we also see people starting with crypto rails and people with fintechs, but the cool part of this space is that the fintechs are using crypto and they're moving wholesale to the crypto rails, and those people have users. It's very common for me to see someone that has 10 million monthly active users, 20 million monthly active users, in Africa or in South America or in Asia, and they already have this customer base, and they're sort of moving to crypto rails. And that to me is very exciting.
Yeah, and I agree. FinTech was one of the buckets I said, excluding FinTech, because it's obvious that money is one of the largest applications on earth.
Aha, but the beautiful part here is that the reason why we never talk about non-financial products in crypto or non-financial use cases is because crypto turns everything into a financial use case. You cannot give me.
Oh, that's true.
You cannot give me an example of a crypto company that I can't just turn it around and say, no, that's a financial company. Everything, like social, I'm selling my social network. Like when you add to.
But everything is already a transaction. You just don't know it. So every time you go onto Google, every time you go onto X, somebody's monetizing you.
That's exactly.
And the idea of Web3 is we can monetize ourselves. So it's a broader distribution of the capital available that gets monetized. So everything we do is time is money.
That's right. That's right.
Our time, our attention is money.
And the other thing, by the way, that I'm very complaining about this one in crypto is that every time something works, just the public in general like removes it as something that crypto did. So a good example, I mean, stablecoins are the ways like stablecoins are no longer crypto. People don't even give us the credit that is actually crypto rails. They just say no, that is a payment system. That is something that I can see value for, whatever. So to a certain extent, you start excising the things that are working from crypto. Oh, RWAs are institutions just wanting to have like faster settlement and more liquidity. That's not crypto. Oh, stablecoins are just tokenized dollars. That's not crypto. And then you end up removing, and you end up with what?
They won't let us have nice things.
That's right. You can't have nice things.
You mentioned institutions. I want to talk for a second about institutions. Obviously, Anchorage, you service a lot of institutions when you're building Anchorage. There's been a long time refrain in crypto. The institutions are coming. The institutions are coming. BlackRock now has launched some of the most successful ETFs in history. They've got their own on-chain money markets. We've got RWAs growing at a record pace, stablecoins, as you mentioned. Even folks like Morgan Stanley and JP Morgan, all these people are coming around the table. Is this it? The institutions are here. Is this what it means for the institutions to be here? Are we waiting for something else? Or like, is it over now? The institutions are in, and now we have something else to look forward to.
So I'll take this one just because I think what you're implying here is sort of like, Diogo, Bitcoin is 16 years old. We keep saying that this is early. And
is it still early?
Is this early? So no, it's not early for Bitcoin. 16 years, I don't think is early. However, I think it's fair to say that crypto, again, is not a monolith. There's so many things that are happening simultaneously. RWAs, the infrastructure. I mean, look, legitimately, until 18 months ago, we didn't have sub 1 cent instant settlement in a blockchain that people trusted. We didn't really have that available. It wasn't there. And definitely wasn't there where institutions thought it was trustworthy, which is the other next step. Now it is. And so that's why you're seeing now this adoption. But we're at the beginning of that cycle. So you can't put stablecoins and say, no, Bitcoin has been around for 16 years, where the hack is like stablecoin, like why is it not 50% of the remittance market in the world? Well, the answer is because, we had issues with things that were called stablecoins that were installed stablecoins. That set us back. We didn't have blockchains with sub-1 cent transactions. Transactions were very expensive. We didn't have issuers that were transparent enough and that had transparency that such that institutions could trust. So you can't actually, I think it's unfair. You have to unbundle it. And you have to look at every cycle on its own timeline. And in that sense, yes, institutions are here and they are really building. It's just it's been 2 years, 3 years for some of the big ones.
And there's two parts of the institutional space. There's all of the financial industry itself using blockchain rails. But what matters to them is, A, the transactions they do amongst each other. The other thing is a function of customer demand. So the big pension plans, the big pools of capital, they've barely done anything. I mean, barely done anything so far, because the regulatory environment's been so difficult. So we've got all of the endowments, all of the pensions, the insurance companies, the reinsurance companies, these massive pools of capital, hundreds of trillions of dollars, have barely started. So the banks and the entire financial industry, you're seeing Apollo tokenized funds, stuff like that. Well, who really wants to buy that stuff yet? Their customers can't do it. So they're solving small parts to test out the technology. This whole thing really is going to play out over the next 5 years and not the next 1 year, because these guys don't move at that speed.
Got it. So institutions are coming, but of a different kind than the one that we already see.
Yeah, they're here, and there's various component parts that need to change. And a lot of this, to get equities on chain, that's a big battle amongst so many incumbents.
Right.
That's the hard thing.
As you were mentioning.
And they're also not startups. It's not like they're here and then all of a sudden in 3 months they build like amazing products. No, these things kind of like stay on their labs for 18 months and then they kind of like get to prod. And the best thing to have an institution do something is when another institution does something about it. And so obviously BlackRock was extremely important for the space. All of these large institutions like Visa, Stripe coming to the space, those are the catalysts. Basically, like the starting guns have been when some large institution does, so you can only start measuring like when institutions will have real products that use crypto at a large adoption, not from the time where stablecoins were created, but from the time where BlackRock actually adopted it.
Yeah, you're setting the clock for the adoption effects now, and you need to look at that.
Yeah. Okay, so to wrap up, I want you guys to paint me a picture of what this cycle is going to look like. So paint me a picture just from now, call it to the next 12 months. What should I be looking forward to? What are the big milestones? What should I be watching out for that's going to matter to the overall shape of this market? Diogo, why don't you go first?
Thank you.
As the macro guy?
Yeah, as the macro guy, clearly. Let me just say, I hate making predictions because I hate being wrong. And so this is actually where I come from.
Hey, you're on stage at Token. Yeah. We're here to make predictions.
So one of the ones that I have for myself is, I think I don't know if it's this cycle, but I think it will be this cycle still, this concept of on-chain IPOs, of let's not lower the bar of quality, but let's lower the bar of revenue of what's necessary for a company to actually be listed on-chain, and make that a path to actually then be listed in a publicly traded company. Companies are staying private for longer. $500 million is known to be one of the marks in which like an actual underwriter gets excited. Why? Why is that the case? So let's actually like solve our own problem and actually create value and create utility by automating and making it easier for companies to be listed. I think this is actually a good thing and it's a narrative. And I think we're already seeing announcements, people trying to do this. And it's not distributed generally as a trend, but I think it's going to be a trend for this next cycle is going to be on-chain IPOs, which is a fascinating turn of events. They're actual securities. They're actual securities, they're registered securities, they're legal, they have all of the apparatus, they're going to be on-chain. The second one that I like, but it's kind of like more pie in the sky, is this thing that I've been calling generative finance, which is most of AI to crypto combination is obviously not very real, like a lot of these things are not real. But one thing that's kind of interesting is I can say two statements that are pretty uncontroversial. One of them is that right now we have the ability of turning language into code, and those are LLMs, and it's only getting better. And the second statement is we also have the ability through DeFi to turn code into financial instruments. So if you take one and the other, that means that we have the ability to turn language into financial instruments. And that is what I'm calling generative finance, which is pretty cool. So a lot of innovation. I don't know if it's this cycle, but a lot of stuff will come from hyper-specialized financial products, hyper-specialized products that can just be built on top of this combination.
Okay, so nothing about liquidity.
Nothing about liquidity.
Okay. Next 12 months, what should we see?
I think IPOs, and that's a big deal. VCs need to recycle capital, and the investors need to recycle capital. That is liquidity. But we're at the point in the cycle where that has to happen. And that will unlock the next wave of capital investment into projects that come out in 2 or 3 years' time. So I think that's really important. I think the rise of the sovereign wealth fund investor, that completely solidifies what Bitcoin is to everybody on Earth. That is happening. So that's going to be a big thing for the rest of the year. And I think somebody this year is going to make a big stab at digital ID. That has to happen. We cannot have AI. We don't know who's who on X anymore. This is a massive problem that's going to have to get solved, and somebody's going to have a stab at it.
Excellent. Well, thank you for sharing all this alpha with us. Round of applause for these two gentlemen.
Thank you.